Welcome back to Economic Insights. I'm Alex, and joining me as always is Selim, market veteran, show producer, and a man who has not had a calm weekend since February. Selim, good morning.
Good morning, Alex. And that's not an exaggeration. As we record this, we're getting reports that the Houthis from Yemen have now entered the conflict with two missile launches against Israel, effectively opening a second front in the regional war. If you thought last week was complicated, buckle up.
Before we even get into the week, that's a significant development.
It is. And it tells you something important. This is no longer contained. When we started covering this conflict a few weeks ago, the question was whether the Strait of Hormuz would stay closed. Now, the question is how many actors pile in, but let's walk through the week, because a lot happened.
Take us through it. Because from the outside, it looked like hope, then despair, then more despair.
That's a fair summary. The week opened with oil above $112 a barrel and Trump's 48-hour ultimatum to Tehran to reopen the strait or face strikes on Iran's power plants, hanging over every market. Asian equities collapsed at the open Monday. And then something totally expected happened, albeit one day early. Taco Monday. Trump announced a 5-day suspension of planned strikes, citing productive conversations. Oil plunged back under $100. Equities surged. Bonds rallied. For about a day, people allowed themselves to believe there was an off ramp.
I remember seeing those headlines. What went wrong?
Midweek, everything unraveled. There were reports of a US 15-point plan and a proposed 30-day ceasefire. But Iranian officials came out publicly and rejected it. Not quietly, not diplomatically. They listed their demands: closure of US military bases, an end to Israeli strikes on Hezbollah, recognition of Iran's authority over the strait. These aren't negotiating positions. These are conditions designed to be refused. Meanwhile, data midweek showed PMIs deteriorating across both the US and the Eurozone, and private credit funds, Apollo, Ares, started limiting investor withdrawals. Three bad stories landing at the same time.
And then the escalation.
Late in the week, US and Israeli forces reportedly struck Iranian nuclear and steel facilities. Iran retaliated across the Persian Gulf. Oil jumped back above $114. The tech sector got its own separate shock. Google announced a data compression technique that could dramatically reduce the memory storage needed for AI, and semiconductor stocks collapsed. The Philadelphia Semiconductor Index fell nearly 5%. You had a geopolitical shock and a tech-specific shock in the same afternoon.
And then Friday.
And then Friday. Despite Trump having announced a 10-day extension to the pause on striking Iranian energy plants, the markets went materially lower. The Nasdaq 100 and the Dow both fell into correction territory. This was the longest weekly losing streak for stocks since 2022. Even Bitcoin, which sometimes moves independently, retreated to near its March low, around 66,600. Cathie Wood's ARK Invest reportedly rotated into cash over the past few days. When the growth investors start hoarding cash, that tells you something about sentiment.
So the market heard the 10-day extension and essentially said, "We don't believe you."
Exactly. And given what happened Monday, the rally, the reversal, all within the same trading session, you can't blame them. The credibility of these extensions is eroding.
Let's go into developed markets. Starting with the US, where do rates and the economy stand?
The US 10-year Treasury yield ended the week around 4.42%, and the 2-year is at about 3.91%. One interesting dynamic: Treasury yields are seeing their largest moves during Tokyo trading hours, bigger than moves in London or New York sessions. That's consistent with Asian central banks selling US Treasuries to fund FX intervention, which is something we're watching closely.
And what does the data say about the underlying economy?
Mixed, which is the most uncomfortable answer. The flash manufacturing PMI for March actually rose slightly to 52.4. That's into expansion territory, partly because companies are front-running supply disruptions by stockpiling. But services PMI slipped to 51.1. continuing a downward trend that's been in place since last July. And input prices, what businesses pay for their raw materials, are surging. The labor market is holding up. Initial claims came in at 210,000. Continuing claims fell to their lowest level since mid-2024. But there's a nuance, a suspicious 9,000 drop in Puerto Rico's continuing claims that may get revised. And mortgage applications fell 5.4% in a single week.
Where are we headed on inflation?
Core PCE for February is tracking at 0.38% for the month, translating to roughly 3% over 12 months. But that's a backward-looking figure. The forward picture is more concerning. Retail gasoline prices risk reaching or exceeding $5 a gallon. Analysts have already revised 2026 headline CPI up to 3.3% and core CPI to 3.2%. And there's a specific worry: if elevated gasoline prices persist, they could wipe out the consumer benefit from the One Big Beautiful Bill tax cuts. The government is paying on one hand, and the energy shock is taking on the other.
What does all this mean for the Fed?
The Fed is expected to hold at its April meeting and formally shift to what analysts are calling a symmetric policy bias, meaning it's now explicitly acknowledging that rate hikes are a tail risk, not just rate cuts. The median projection from the FOMC plot currently suggests one cut this year, but 4 members of the committee are projecting no cuts at all. Markets are pricing in roughly a 50% probability of at least one hike by year end. The Fed's dual mandate gives it more patience than the ECB or the Bank of England. It doesn't have to choose between inflation and growth quite as starkly. But that patience isn't unlimited.
There's one more thing I want to touch on from the US. The private credit story. You mentioned Apollo and Ares limiting withdrawals. How serious is this?
This is the part of the market that's been quietly deteriorating, and it's starting to get louder. The private credit industry manages roughly $1.7 trillion in leveraged corporate loans. Several major fund managers are now receiving redemption requests exceeding 11% of their outstanding shares, and they're capping quarterly payouts at 5%. So, investors who want their money back cannot get it. One large private credit fund was recently downgraded to junk status due to rising non-accrual rates, portfolio markdowns, and heavy reliance on payment in kind income, where borrowers pay interest in more debt rather than cash. That's a yellow flag, not a red flag yet. About a quarter of business development company loans go to software companies, which are both highly leveraged and increasingly under pressure from AI disrupting their business models. Analysts describe the systemic risk as manageable. A severe scenario might produce a 0.2 to 0.5 percentage point drag on GDP. But the liquidity gates are a warning sign. When fund managers stop letting people out, that tends to be the beginning of a story, not the end.
Moving to Europe, the ECB is apparently pivoting to hikes.
The ECB faces the same stagflation dilemma everyone else does, but with less insulation from energy prices. Europe imports most of its oil and gas. The Eurozone is genuinely exposed. The composite PMI hit a 10-month low of 50.5. Supplier delivery times have lengthened to their worst since August 2022. And money markets are now pricing in 80 to 85 basis points of cumulative hikes by mid-2027. Some houses are expecting the first hike as early as April. There's a nuance across countries. Italy is getting hit harder because it relies on natural gas for electricity generation. France is showing the weakest pass-through historically. Germany had a strange anomaly. Manufacturing actually picked up briefly because companies were front-running war-related supply disruptions, building inventory buffers. None of this is comfortable, but the regional variation matters for how the ECB calibrates.
The UK?
The UK is facing a genuine stagflation shock. February CPI was 3% headline, but core surprised to the upside at 3.2%. Manufacturing input prices in March soared 14 points to 70.2, the largest single-month jump since 1992. CBI retail sales collapsed to minus 52, the third lowest reading since 1983. To give you a sense of where household expectations have gone, The Citi/YouGov 1 year inflation expectation jumped from 3.3% in February to 5.4% in March. That's a massive move. Markets have shifted from pricing 50 basis points of cuts to pricing almost 80 basis points of hikes. One interesting technical point. Some analysts calculate that £4 billion in targeted government spending to discount household energy bills could mechanically lower CPI by zero point 0.4 percentage points. And by reducing front end rate expectations, it would save the government 3.3 to 3.6 billion pounds in debt servicing costs. So the intervention could essentially pay for itself.
And Japan?
Japan is an interesting case. 90% of Japan's crude oil comes from the Middle East. Dubai crude prices hit $170 a barrel. The government responded by reimposing retail gasoline subsidies, capping prices, and releasing strategic reserves. Japan holds about 250 days of oil reserves, which is an enormous buffer. The BOJ April meeting is live. Markets are pricing roughly 60% probability of a hike. But there's a tension. If the market's focus shifts from upside inflation risk to downside growth risk, that probability could deflate quickly. The yen is testing 160 against the dollar. It's notable that the yen is not getting its traditional safe haven bid. Investors are choosing the dollar and the franc instead, which tells you something about how they're interpreting Japan's energy vulnerability.
FX and commodities. Where does the dollar stand?
The dollar hit fresh 2026 highs this week. Two drivers: safe haven flows from geopolitical tension and the structural advantage that US energy independence gives it. When oil prices surge, the dollar tends to strengthen because the US is an exporter and most oil is priced in dollars. So the petrodollar system benefits America when energy is expensive. Euro tested below 115. Sterling hit its low below 133. One surprise outperformer, the Norwegian krone, second best in G10 after Norges Bank signaled a rate hike. Oil helps if you're sitting on North Sea reserves.
Gold. You'd think gold would be surging right now. Instead, it's falling.
Gold has dropped 15% since the start of the conflict, falling to around $4,320 an ounce, its longest losing streak since October 2023. It's deeply counterintuitive, but the mechanics make sense once you unpack them. The strong dollar is the primary culprit. Gold priced in dollars gets cheaper for foreigners when the dollar strengthens, but it also means dollar-denominated gold faces a natural headwind. On top of that, Asian central banks defending their currencies are selling US treasuries to raise dollars, and that deleveraging tends to hit gold too. Developed market gold ETFs have seen substantial selling, with gold sensitivity to ETF outflows running at 6 times its historical average. There's also a hawkish monetary policy signal baked in. When central banks signal higher rates, gold suffers.
Oil, where does it sit?
Around $114 a barrel, back at its peaks from earlier in the conflict. The supply picture is severe. 16 million barrels a day were sidelined when the strait closed. Through rerouting via Saudi Arabia's Yanbu pipeline and the UAE's Fujairah route, plus strategic reserve releases, analysts estimate the global shortfall is now around 10 million barrels per day. But now with Houthis joining the war, that's not clear either. And this shock is spreading geographically at the speed of shipping transit times. Asia is feeling the physical squeeze first, Africa next, Europe by mid-April, the US last, primarily on the West Coast. Global inventories have already fallen by 155 million barrels in early March, almost entirely from oil in transit declining. Natural gas is equally dramatic. European gas prices surged 64% because Qatar's LNG facilities were hit. Qatar accounts for roughly a third of global helium output, critical for semiconductors. Fertilizer prices are up 65% in a month. The cascade through connected markets is extraordinary.
Emerging markets. Let's start with where the oil shock is hitting hardest versus where there's some insulation.
The clearest divide is oil importers versus exporters. Brazil, Norway, Kazakhstan. They're actually seeing terms of trade improvements. Brazil's currency has outperformed its peers. It cut rates by 25 basis points this week, though cautiously. On the other side, India, South Korea, Turkey, the Philippines, Thailand, they're taking the worst of it. Foreign portfolio outflows from Asia ex China equities hit around $51 billion this month. EM credit spreads, interestingly, have barely widened, which analysts read as spreads being too tight rather than a sign of resilience. They're underweighting EM credit as a result.
Let's head over to China.
China has more insulation than most. Over 50% of its energy mix is domestic coal. It holds about 108 days of strategic crude import cover. The PBOC has been setting the yuan fix slightly weaker than consensus, tactically tolerating some depreciation rather than fighting it. The government halved the scheduled retail fuel price increases administratively, but the domestic demand picture is fragile. The policy buffer exists, but it's a tool for cushioning, not reversing.
India?
India is heavily exposed. Half its oil and gas passes through the Strait of Hormuz. Headline inflation is projected to peak around 6% by Q4. The rupee is under pressure from both importer dollar demand and portfolio outflows. The RBI faces a genuine dilemma: rate hikes to anchor the currency and inflation, or patience to avoid crushing growth. Views are divided, with some houses expecting 50 basis points of hikes this year.
Turkey, you mentioned there's a lot more to say this week.
Turkey is one of the most instructive cases right now because you can see a central bank fighting hard to hold the line, but at a significant cost. The Central Bank of Turkey has tightened its effective funding rate to 40%, and it has intervened in FX markets to the tune of roughly $30 billion over the past 3 weeks. Despite all this, the lira has only depreciated about 0.6% since early March, so the intervention is working. But the question is how long they can sustain it.
What's the cost?
The numbers are striking. Gross foreign assets dropped by $33 billion in March, bringing the total to somewhere in the $164 to $177 billion range. The central bank's net FX position fell to roughly $16.6 billion, its lowest level since the financial turmoil of early 2025. And there's been an interesting maneuver. To bolster usable reserves, the central bank has reportedly expanded gold for FX swap operations. In mid-March alone, net gold reserves fell by about 53 tons, roughly $8 billion, which effectively converted gold holdings into usable FX liquidity. Meanwhile, carry trade positioning has unwound significantly. Foreign investors have exited about $16.5 billion of carry trades since the conflict began, taking total carry positioning from about 44 billion down to 27 billion. Foreign funds sold 1.1 billion in Turkish equities and 4.6 billion in local bonds in just the first 2 weeks of March.
What does this mean for Turkish inflation and growth?
The macro projections have been revised sharply. Year-end 2026 inflation is now forecast at 27.5%, up significantly from pre-conflict expectations, driven by the external energy shock, rapid fuel price pass-through, and second-round effects spilling into services. GDP growth has been cut. The current account deficit is expected to widen to about 3% of GDP. Turkey is heavily reliant on energy imports. Tourism revenues, which hit $64 billion in 2025, remain a critical mitigating factor, but they're now at risk if the regional conflict damps travel. The year-end policy rate forecast has been revised up to 33.5%. Rate cuts are off the table for the near term. If reserve erosion continues or inflation expectations become unanchored, an explicit rate hike becomes necessary.
South Africa?
The SARB held at 6.75%, unanimous decision, but the language was unmistakably hawkish. Coming months will be critical for evaluating the long-term inflationary impact of the oil shock. The SARB revised its 2026 inflation forecast up to 3.7%, and the message was explicit. The committee could hike as early as May if oil stays in triple digits and second round effects materialize. The ZAR depreciated 6.8% since early March. South African equities, the MSCI SA index, fell 21% in dollar terms since the conflict started.
Egypt?
Egypt is navigating this carefully. February inflation hit 13.4% year on year. The Central Bank of Egypt is expected to hold through the first half, and JP Morgan has revised Egypt's rate cut expectations down to 400 basis points in 2026 from 600 previously, because the inflation backdrop simply doesn't allow as much easing. Egypt's structural vulnerability here is the dependence on GCC inflows. About 9 to 10% of GDP comes from Gulf sources. If Gulf economies are under strain from the conflict, that pipeline narrows.
Looking ahead. You said it's a heavy data week.
It's one of the heaviest. 3 things to watch. First, US jobs data. The March employment report comes out Friday. Expectations are for a gain of 60,000. Unemployment rate could tick up to 4.5%. There's a mechanical boost from the return of roughly 30,000 striking healthcare workers, but the underlying trend is clearly slowing. We'll also get the February JOLTS report on Tuesday and ADP on Wednesday. Fed Chair Powell and New York Fed's John Williams both speak Monday. Expect cautious language on inflation.
And Europe?
This is arguably the most important data point for near-term ECB policy. Flash March CPI prints for Germany on Monday, France and the broader Eurozone on Tuesday. Economists are expecting Eurozone headline inflation to jump roughly 0.7 percentage points to 2.6%, the most significant spike since 2022. This is the first hard evidence of how the energy shock is transmitting into consumer prices. If it comes in above that, the case for an April ECB hike becomes very difficult to resist. Policymakers have explicitly said they do not want to repeat the mistake of 2022 when they were too slow. Markets are watching this number very carefully.
In Asia?
On Tuesday, we get the first real-time read on how Chinese activity is responding to the global shock. Japan has a busy schedule. The BOJ releases its summary of opinions from the March meeting on Monday. Tokyo, CPI, and February industrial production come on Tuesday. The highly anticipated Tankan Business Survey follows on Wednesday. And Australia had a 5-4 decision to hike rates at its last meeting. The RBA minutes on Tuesday will show how close that call was and what would tip the balance either way.
And the geopolitical wildcard.
April 6th, the deadline. Markets have largely stopped believing these extensions matter. Friday's sell-off made that clear. But a deadline is still a deadline. Whether it passes quietly, gets extended again, or triggers an escalation will shape the entire tone of markets for the following week. And as we noted at the top, the geography of this war is expanding. The risk isn't just how long this lasts, it's how wide it spreads.
So, payrolls, Eurozone inflation, April 6th, and a new front in a war. Not a quiet week.
It never is anymore, Alex. The window for a quick resolution has essentially closed. Don't forget, the supply shock doesn't reverse the moment someone shakes hands. Pipelines, shipping routes, inventory levels, business confidence, these things take time to heal. The market knows that now.
Selim, thank you as always.
Stay careful out there.
Don't forget, folks, we do not give investment advice. For that, please consult a professional. We'll see you next week.